Alright, for this video we're going to talk about straight line depreciation. It's a straight line method of depreciating a fixed asset. Remember, depreciation is the decrease in usefulness over time. Here's our example. Feel free to screen capture or take a picture of it, as I will refer back to this example. We're going to calculate the depreciation expense for the first, second, and third year. We're also going to go into the journal entries, and then finally calculate the net book value on the balance sheet after the third year for the equipment. We'll need to know one formula for the depreciation expense for straight line method. And the formula is the following for the depreciation expense. Once you calculate this, this will be the amount that you will depreciate the asset, in this case the equipment, every year. First you take the cost minus the residual value. Then you're going to divide that by the useful life. And this is usually expressed in number of years. So let's put useful life in years. This formula again will give you the depreciation expense for every single year of the life or over the life of the asset. Now let's calculate the depreciation expense for years 1, 2, and 3. For year 1, we're just going to plug it into the formula here. Our cost is $410,000. You're going to subtract your residual value, which is $10,000. And then you're going to divide by the useful life in years, and in this problem it is 10 years. That will give us $400,000. And then we're going to divide that by, again, 10 years. And that will give us a depreciation expense of $40,000. And again, that's per year. Because this is straight line depreciation, it's the easiest of all the methods of depreciation. Every single year will give you the exact same calculation, and it will equate to the same amount, which is $40,000 per year. So right now I'm going to fast forward this video because it is the same calculation and again the same amount per year. I'm back, and now let's do the corresponding journal entries for each year. Just like the calculations, it's very simple, as every year will be the exact same amount, and also it'll be the exact same debit and credit. So let's do year 1. In year 1, you're going to debit depreciation expense for $40,000, as we calculated previously. And then you want to credit an account, which is a contra asset account called accumulated depreciation. This contra asset will bring down another asset, and in this case it is our equipment account on the balance sheet. So that's $40,000. And again, time to speed it up because again it is the exact same journal entry for year 2 and year 3. Lastly, we're going to calculate the net book value on the balance sheet. Here, we're going to take the fixed asset that we have, which in this case is the equipment, and subtract the accumulated depreciation. That will give us our net book value. So here, again, this is at the end of year 3. You could actually calculate the net book value after each year. It just depends on how or what the problem is asking. So let's put our equipment down. Our equipment originally cost $410,000. And then our accumulated depreciation, which again is a contra asset, an asset that brings down the equipment asset account, is going to be all your accumulated depreciation entries added up together from the previous years, or for all 3 years. In this case, it's going to be a subtraction of $120,000. And then finally, you will have your net book value after you take the difference between the two values, $410,000 and the $120,000. This will give you $290,000, a value you'll need when you decide to sell or discard the asset.